Howdy, y'all. Welcome back. It's the weekly economic update for December 6th, 2021. Hope everyone had a fantastic weekend out there in the interwebs and pretty good weekend here in Colorado. Some cool weather came in yesterday. It was like a sandstorm and like 30-degree drop of in weather. So went from like 65 degrees down into the 30s within about 10 minutes. So that was fun. But nice and nipply outside today. I think my wife said it was 10 degrees when she got up, and it's a balmy 30-something right now. So, all right. Well, hope everyone, like I said, had a great weekend. Let's go ahead and dive into the weekly update. All right. The week on Wall Street, stocks took investors on a wild ride last week as Omicron variant and the Fed comments upended market expectations. The Dow Jones Industrial Average fell 0.91. The S&P 500 fell 1.22. NASDAQ was down 2.62. And the internationals were down 0.62. Excuse me. A tumultuous week. Stock prices were volatile all week, swinging wildly after staging a modest recovery to begin the week. Omicron fears were not the only issue weighing on investors. Markets were also rattled by Fed Chair Powell's congressional testimony stating conditions warranted considering an acceleration of its bond purchase taper schedule. Last week's roller coaster action was epitomized on Wednesday when stocks rallied intraday by 520 points on the Dow Industrials, only to close the session lower by 460 points. So about a 1,000-point swing there. Stocks staged a powerful rebound on Thursday on news that a second Omicron infection exhibited mild symptoms. Also helping the rebound was news that an agreement was reached in the House of Representatives to temporarily fund the government, and word from the President Biden that an economic lockdown was not in the plan to fight COVID this winter. Emblematic of the volatile week, stocks fell on Friday following a weak jobs report. So, yeah, kind of back and forth. The VIX I had talked about on my Friday video had been up above 30 for several days in a row. Today it has pulled back. Let's see what it closed at today. The VIX is at 27.5. So it's down below 30 for now. We'll see, is today an anomaly with the market being up, or will we continue, or that's what an anomaly is, duh. Is today just a one-off and it's going to continue on the downtrend, or is this, a sign of, a stronger market and things are going to go back on that upward trend? So a little too soon to say. All right. Stocks staged a powerful rebound on Thursday on news that a second Omicron, I already read that part. Yeah. Powell surprises markets. Markets easily digested the Fed's early November announcement that it would pull the trigger on its bond purchasing taper program, but were caught off guard by Powell's comments during congressional testimony last Thursday. Powell indicated that the Fed would discuss the option of accelerating its tapering plans at its next meeting. Excuse me. Got a frog in my throat. And if you've never been to Rudy's Barbecue, it's quite delicious. All right. Powell cited the risk of higher inflation and substantial improvements in the labor market as warranting ending bond purchases a few months sooner than planned. Powell sought to move away from describing inflation as transitory, acknowledging that rising energy prices, higher rent, and strong wage gains could keep inflation elevated, though he maintained inflation would decline sometime in 2022. I wonder if he has a crystal ball, because not sure how he knows that. All right. Economic data coming out this week. The job openings and labor turnover survey comes out on Wednesday. Jobless claims on Thursday, and Friday is the consumer price index and consumer sentiment. There's a number of companies reporting earnings this week. Coupa Software and MongoDB are reporting today. Tomorrow is AutoZone. Wednesday is GameStop and UPath. Thursday is Lululemon Athletica, Broadcom, Costco Wholesale, and Chewy. So that rounds out the week as far as earnings. All right. I also have to those on my email list are going to receive a monthly economic update. Going to just breeze through this. We've probably covered a lot of this stuff in our weekly videos. So, all right, U.S. markets, reports of a new COVID-19 variant in late November roiled markets as a wave of selling erased the month's earlier gains. The Dow Jones took the hardest hit, dropping 3.73 in the month. The S&P 500 was down 0.83, and the NASDAQ managed a small gain of 0.25. Thanksgiving surprise. The markets were blindsided by news over Thanksgiving Day of the emergence of a new strain of COVID-19, which led to travel bans by multiple countries and renewed unease about the prospect of a return to economic and social restrictions. The potential global spread of this new COVID-19 variant, Omicron, triggered fears of another round of economic deceleration, sending investors back to their pandemic playbook of selling travel and leisure, financials, energy, and cyclicals, and buying pharmaceutical companies and stay-at-home stocks. Volatile trading. The sharp drop on Friday, November 26th, was exacerbated by reduced liquidity in the markets due to many traders being absent on this normally quiet post-holiday shortened trading session. Stocks rebounded as traders returned to work the following Monday, but were unable to hold their gains on the month's final trading day. Upbeat company reports. The month had started off on a strong note, helped by a string of positive corporate earnings surprises, optimistic forward guidance from companies, and solid economic growth. Investors were particularly encouraged by the fact that businesses had navigated the challenges of a surge in the Delta variant, infections in the third quarter, rising inflation, and supply chain bottlenecks. The Fed's headlines. Developments in the Federal Reserve policy dominated much investor attention throughout the course of November. The first of these was the Fed announcement that it would begin its bond tapering program. Markets were unfazed by this news, as they had long anticipated the Fed would soon commence paring back its monthly bond purchases. The second was the uncertainty surrounding whether Jerome Powell would be renominated to serve another 4 years as Fed chair. When President Biden finally announced his decision to renominate Powell, bond yields rose as investors became more certain that the Fed's monetary normalization policy would proceed as planned. Omicron uncertainty. The consensus narrative of healthy economic expansion in 2022 was left a bit dented by the introduction of the Omicron variant. Many questions surround the new variant and its impacts on global economies. Markets don't always respond efficiently with an information void, creating the potential of further volatility until more is known about Omicron. Well, the news out of the doctors in South Africa have stated that it's fairly mild, so I wouldn't get your panties in a bunch. All right. Most of this is just a lot of fluff, so you're welcome to read that at your own leisure. Okay, the power of the consumer. 2 white papers going out. This one seems a little like filler. My ghostwriter putting these out. Let's see. A confident consumer can be a powerful ally in the economy, but when the consumer starts to have questions, we can measure consumer confidence in everything from retail sales to home buying to the personal savings rate. In recent months, consumer confidence has been falling as inflation expectations have been rising. So if inflation shows, does that mean consumer will regain confidence? It's possible, but other factors can influence consumer confidence, including perceptions of COVID-19. When the consumer does regain confidence, we may expect it to be a powerful powerful force driving economic growth. God, I can't read today. Many base the 2022 U.S. economic outlooks on a rebound in consumer confidence, leading to an increase in spending. In some ways, the only consumer confidence that matters is yours. Are you optimistic about 2022? So we'll see. All right. And one more white paper. This has to do with premiums and deductibles for Medicare. I think I might have covered this in an article I read last week, but I'll go ahead and breeze through this. As Medicare's open enrollment period is due to end December 7th, which is tomorrow, recipients of the program are preparing for larger than expected jump in prices for premiums and deductibles. For example, Medicare Part B monthly premiums are set to rise to $170.10, a 14.5% increase, and much higher than the estimate of 6.7%. The deductible for Part B will rise to $233, a 14.8% increase, and the Part A deductible will increase to $1,556, up $72 in 2022. While many Medicare programs will carry over if participants take no action, it's not clear that everyone is aware of the increase that's coming. According to a recent survey from Medicare guide.com. 67% of beneficiaries hadn't looked at their choices by mid-November, with the Kaiser Family Foundation discovered that 71% don't review their options at all during the open enrollment period. Probably not a good idea. All right. And I have a couple articles I want to go over real quick. Let's see how long I've been rambling so far. Come on. There we go. 10 minutes. So I'm good. All right. This article comes from First Trust, Brian Westbury, their chief economist. It's titled Volatility and Fear. All right, let's dive in. At the close on Friday, the NASDAQ Composite Index was down 6.1%, and the S&P 500 was down 3.5% from their recent all-time highs. The 10-year Treasury yield was 1.67% as recently as the week of Thanksgiving, was yielding 1.35 at the close on Friday. Oil prices have fallen about 22% from their highs, and Bitcoin was down about 28% over the past weekend. Some investors are worried about the Omicron variant of COVID-19 and maybe further variants to come, but many are concerned about the Federal Reserve speeding up its pace of tapering, quantitative easing, which could set the stage for interest rate hikes in 2022. Meanwhile, the odds of passing President Biden's signature fiscal plan, the so-called Build Back Better proposal, appeared to be no better than 50%, down significantly from earlier in the year. Probably a good thing because most of it is fluff. It's a lot of pork, very little for actual infrastructure, in my opinion. What this reminds us of is the stop-go, God, I hate this word, Keynesianism of the 1970s, where policymakers would whipsaw between goosing the economy through loose money and extra government spending, then battling to the ensuing inflation by tightening monetary policy, slowing the growth of spending, or even by raising taxes. This ping-pong policymaking was not healthy for the stock market. The S&P 500 increased at a 1.6 annual rate in the 1970s as consumer prices rose 7.4%. In recent weeks, the stock market has decided the economic pain associated with the eventual tightening of fiscal and monetary policy is more likely to come sooner rather than later. Investors realize the budget deficit in this year ahead is likely to be much smaller than past couple of years, which will be good for the long run, but could be an economic headwind in the near future. Meanwhile, the Fed meets next week, and recent testimony by Fed Chairman Jerome Powell indicates it will likely hasten the pace of tapering. One theory is that the Fed could finish tapering as early as March next year. Let's see. That's consistent with the futures market for federal funds, which appears to be pricing in 2 or 3 rate hikes in 2022, assuming the rate hikes are 25 basis points each. We think taking the economic pain earlier rather than later is the better option. Those in charge will probably go for the opposite. They'd rather have pain later and not have to deal with it now. The next report on consumer prices arrives on Friday, and we are estimating an increase of 0.7% in November. If we're right, that would mean consumer prices are up 6.8 from a year ago, the largest increase for any 12 months since the early 1980s. The Fed no longer waits to address this, the harder it will be to stop. The longer the Fed waits to address this, the harder it will be to stop. In the early 1980s, Paul Volcker ended up pushing the federal funds rate to nearly 20%, which caused a brutal set of recessions. Some tightening now versus more tightening later would signal wisdom in managing monetary policy. And then worst case scenario, everything falls apart and then there's nothing to put back together. So, it's kind of like you want to put together big pieces or have it, little tiny smash pieces. All right. So I'll go ahead and finish that one up. All right. Then the next article comes from John Malden, probably one of my favorite economists. It's called Capital Excess. Let's see. Let me scroll down here. Where was I? All right. Where was I? Yeah, this has, I'll just start up here at the top. All right. Why do we invest? Everyone has their reasons, but funding retirement may be the most common one. Whenever the time comes, we want to relax in comfort and security. Yet this whole retirement idea is really quite new. For most of human history, almost everyone worked as long as they physically could, then expired soon after they couldn't. Capping your life with a few years of leisure wasn't an option. Without an extended family that would take care of you, life was solitary, poor, nasty, brutish, and short, to quote Thomas Hobbes. A comfortable retirement is possible now, or at least we hope it is, but we're never quite sure, which is why we stay nervous about our portfolios. Self-directed retirement investing is also new. Other than Social Security, U.S. retirement benefits came mostly from employer and union pension plans. Until just a few decades ago, your employer would put money into a big pool where professionals would invest it on your behalf and pay you some kind of a defined benefit upon reaching retirement age. This was normal and worked pretty well. In 1978, Congress passed a law allowing tax-deferred compensation for bonuses and stock options. The relevant clause was Section 401k. The benefits consultant Ted Benna saw it could be used to create tax-advantaged savings accounts. Companies jumped on the idea quickly because it was simpler and less expensive than funding their defined benefit plans. Workers like the idea of being in control of their retirement money. Today, the old-style plans are rare in the private sector, but they remain common in state and local governments. Yeah, well, probably because you can tax the populace to continue to pay for them. This new arrangement, while an improvement in some ways, generated different challenges. Giving workers control over their own investments presumed that they would invest wisely, which is often not the case. It turns out humans are, well, human with evolutionary survival traits that are not necessarily the best traits for investing. An entire subset of economics called behavioral economics has evolved, pun intended, to describe our human foibles. But the even bigger problem is the employers who kept DB plans without adequately funding them and or generating returns sufficient to pay the promised benefits. It is a systemic problem that affects others. Today, we'll discuss this problem and some of its macro-level consequences. The funding gap. I've written about the underfunded pension problem many times, most recently in October of 2019. A few months earlier, I had said your pension may be monetized. It's a slow-moving crisis that, in theory, should be hard to avoid. Fixing it requires cooperation between people with competing interests, so it's still coming. Nevertheless, there is some slight improvement. COVID recovery programs injected a lot of federal cash into state and local government coffers, even as tax revenues rose, often dramatically in some places, thanks to higher property values, capital gains, and increased consumer spending, which raised sales tax revenue. This let some sponsors make additional contributions, some of which were long overdue. A recent Wall Street Journal report said California had transferred an extra $2.3 billion into its teacher and public worker plans, which is a step in the right direction, but sadly a drop in the bucket. Connecticut threw an additional $1.62 billion. New Jersey made its full actuarially calculated contribution for the first time since 1996 and added another $500 million on top. Again, not nearly enough. Nationally, the Pew Charitable Trust reports estimates that state plans will reach an 84% funded level this year, up sharply from 69% the prior year. If an 84% funding level could be maintained, this would be very positive. Then again, that's the average of all states. Some states are dramatically underfunded. Moreover, some of the improvement represents new Treasury debt. It was essentially a federal bailout under another name. The problem was transferred, not resolved. But much of this funding ratio improvement came from gains in the existing plan portfolios. These gains exist mostly on paper on the assumption the plans could sell their assets at the currently lofty market prices. This is fantasy, and so are their numbers. It also doesn't address inflation. Many plans give beneficiaries cost of living adjustments based on CPI or some other benchmark. It's been generally low for the past decade or two. This may not be the case going forward, and I'm relatively sure their funding assumptions don't reflect that possibility. The liabilities these funding ratios have to cover could be significantly bigger than expected. Even if inflation is only 4 to 5% for 2 years, that is a large change for their future liabilities. Unwieldy size. Back to all this new cash. Pension plan managers face the same challenges as other large investors. The more money you need to invest, the fewer choices are available to you. You can't invest in the market when you're big enough to be the market. But staying in cash isn't good either because it dilutes your returns and prevents you from achieving long-term objectives. Some hedge funds and a few mutual funds try to solve this by closing to new investment when they reach an unwieldy size. Many more should do so. They don't because it reduces fee income. They instead come up with a multi-strategy program far afield from the expertise that build their original record. All right, so it's a pretty long article. I'm not going to read every single word here. So basically, the pension plans in our state and local governments are drastically underfunded. It doesn't get a lot of headlines, unfortunately, because it's not a sexy subject. But when they do fall dramatically short, they do stand there with their hands out, expecting us, the taxpayer, to bail them out. So anyways, all right. And the last thing I got is a quick video from Scott Adams. I really enjoy watching or listening to him each morning. And this is from Saturday, and he's talking about the fake news and what you can do for those that you're having an argument with. So this is just something a little fun to listen to as we wrap things up.
So fake news about fake news. Although I appreciate that the Hill did get these, got these percentages, and that did add a lot to the story. I just wish they'd added some more about the raw numbers to balance it in. Why is it that I focus so much on the hoaxes, and why am I going nuts on the hoaxes right now? Does anybody know? Can anybody tell me what's my strategy? Because I like to see how transparent I am sometimes. What's my strategy of going extra hard at the hoaxes right now? Because you've seen me do it on Twitter, right? Why now? Well, persuasion, yes. Attention. I always like persuasion. I always like attention. But those are sort of baseline. Yep. Over on locals, again, correct answer. Correct answer is we might be close to a breaking point. I feel like the last few shoves can push something over the edge. It's like it might not break. I mean, maybe the left's narratives are just too hard and we can't break them. But it sure feels like it. I feel like we're getting really close, right? And if we can get anybody on the left to understand even one of the major hoaxes was a hoax, I think the dam breaks, for at least for that one person. And then if you can get everybody on the left to believe that at least one of the hoaxes was a hoax, suddenly the dam will break. And I'm feeling it. And I want to give you a persuasion technique that is about this one hoax that I think is the one that will unlock, basically unlock the door, or to mix my metaphors, the dam will break. And I think it's the drinking bleach hoax. Now, two things about that are interesting. It's the only double Rupar that I know of. Now, a Rupar edit of a video, it's named after Aaron Rupar. A Rupar edit is when you take part of a video out and somehow that reverses its meaning. That's how the Fine People hoax was done, how the overfeeding koi fish was done, how the Covington kids hoax was done, and then the drinking bleach hoax. But the drinking bleach hoax has an extra element that makes it sticky. It's a double Rupar. It removes the end of it, but also the beginning. And if you don't remove both, then people can still see the context. But if you remove just one of them, it still works. So people will say, no, Scott, let me show you the full quote to show you that you're wrong. And then they won't show me the full quote. They'll show me a half Rupar, like one of the things deleted, which still keeps the wrong meaning, or at least it's ambiguous that way. But if you see the book ends it with light, then he was talking about light the whole time. Okay? So here's what I want you to do if you get into a personal conversation over the holidays with somebody who believes the drinking bleach hoax. Are you ready? This is a way to unprogram them. And I tweeted it, but you can use any version of this for yourself. So if somebody says that Trump suggested drinking bleach, get them for a moment, get their full attention, make sure there are no distractions, right? Because you don't want them to use the distraction to run away from the conversation. Make sure you have their full attention, and then say this. Just want to check with you on your thinking process here. Do you believe that an adult human being with a college education who ran a real estate empire and rose to the presidency of the United States, that person believes that injecting a chemical disinfectant into a human body would be a good idea, such a good idea that he would say it in public? Is that what you believe? Now watch what happens when your subject starts squirming. I don't believe anybody will look at you and say, yup, that's what I believe. I think just asking the question that way, though, and then if they do say that, just repeat yourself. Say, okay, I may have heard you wrong, but it's your actual opinion that a real human being who can function in the world and run a big company, run for president and win, that a human being with that level of education and knowledge about the world actually, literally, really suggested in public to inject a chemical disinfectant into a person. Do you really believe that? Watch what happens. Watch what happens. You're going to shake them to the core because they don't believe that. Then, suppose they say, but Scott, he said it. You just can't talk him out of it. Maybe you don't have access to the transcript. So you're going to say, okay, the president, then here's the backup. Wait for this. You're going to love this next part. You're going to love this next part. Say to him, now, do you believe that when the president used the word disinfectant, he was using it in a medical, scientific sense? Or do you think he was using it in more of a, let's say, a layperson sense, that a disinfectant would be something that gets rid of an infection? Would you accept that the word disinfectant often is used for a chemical disinfectant, but that if you were just using it casually, you would imagine that anything that gets rid of an infection would be a disinfectant? And in fact, they were talking about light in that context as one of, but not the only one, but one of the disinfectants. So do you believe that the president thought there was something you could inject into the body that would get rid of an infection? Do you see where I'm going yet? And then your person will say, ha, 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 there's nothing you can inject. There's nothing you can inject into a body that's going to get rid of a virus. Have you heard of Regeneron? Have you heard of vaccinations?
All right, we'll go ahead and stop that there. So let me stop sharing my screen. Scott's always entertaining. That was, if you want to go back and find that exact spot, it's around the 24-minute mark if you're watching on YouTube. So, but yeah, it's like living in two different worlds. One group thinks that one side is completely nuts and the other side, feels the exact same way. And me sitting here in the middle, I'm like, y'all are both crazy. So, all right. Well, I hope everyone has a fantastic week. I will be back tomorrow with the Liberty Call. And if anyone needs anything from me, be sure to like, subscribe, and share, or send me an email and or give me a phone call. Otherwise, like I said, I'll be back tomorrow, and y'all have a great evening. Bye-bye.